Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, the Sensex breached the 62,000 mark recently, and I'm sure Value Research followers would be really happy about it. But there are others, many others, who would either be worried or disappointed for having missed the bus. Whatever the case may be, what now? What should be your strategy here on? That's exactly what we'll talk about in today's episode. Stay tuned.
Markets at an all-time high means nothing, because if market was close to its all-time high, then it slipped a little bit and then has gone back again to that level. Normally we have this sense that all-time high and the noise around it and market touching an all-time high, that will be a headline. And that is what actually brings it in attention. But I don't think you should really take notice of that. Let's just understand what the market high means. Look at Sensex, and there are 30 constituents of this Sensex. 10 years back, all these companies together on a per unit basis, assuming, I'm just giving an example, I don't have the handy number, but assuming that together all these companies used to earn, their annual earnings was about 1,000 rupee on a per unit basis, because Sensex has a constituent, one company X percentage, Y next company another percentage. So it is a weighted average of those earnings will on a per unit basis, assuming it was 1,000 rupee. Today it surely will be something like 8,000-9,000 rupees in 10 years time, which means that Sensex level or any index level is basically a representation of the earnings and the future earnings potential of those companies, which is reflected in the market price of those underlying companies, and quite a few of them, 30 in case of Sensex, 15 in case of Nifty, and there are other indices. So just because the market has achieved a new high, because normally we, with a number and the noise around it, we think that if it is high, then it is alarming. If it is low, it might be cheap, but there are situations, there are instances, there was a decade when the market was low and it remained low, and it remained low for a reason, because companies were unable to grow their earnings. And if companies continue to grow their earnings, if they are able to earn more, then Sensex will go up. In the short run, there could be a situation that because market on a short term basis is very hard to predict. It is governed by many technical things, investors getting excited about something, or the interest rates and flow of money. Those are primary things. But in the long run, I think the primary driver is earnings. Companies' ability to earn more, grow their earnings. And so one should be looking at it very objectively. Looking at these numbers, it's quite funny that last 1 year, the Sensex touched an all-time high 8 times, which means it slipped and it attained a new high. In the last 3 years, it has attained 86 times. It has touched a new all-time high. And in the last 5 years, it is 133 times. In the last 10 years, it has touched a new high 232 times. That doesn't mean that, market was cheap or expensive at all times. It is just that it achieved a new level, slipped further, and went on to cross that. Sophisticated investors might look at market differently. They will look at market whether it is reasonably valued, or it's richly valued, or it is cheap, depending on the price earning ratio of the underlying company, the growth potential, the price to book value, or the dividend yield. So these are some of the variables which investors look at, or earnings yield. Anything in isolation doesn't work. There is a multiple factors. Of course, optimism of investors is also a very significant driver. And if there are investors who are optimistic and they remain optimistic for a long period of time for any reason, then markets can be expensive and remain expensive. In the period 2003 to 2008, when the market looked like it has achieved a new high from 3,000 points to 4,000 points. 3,000 points to 4,000 points was a 33% jump, and a lot of investors were getting out, a lot of investors were getting in, but market continued its run, and a frantic run. for next 4-5 years to achieve a level of 20,000. So high or low doesn't matter, whether the market is reasonably valued or is it expensive or it's reasonably valued, and will the companies be able to grow their earnings. And I think there the optimism bit is working very much. Based on these variables which sophisticated investors look at, everything looks reasonably valued or little bit on the expensive side. But for mutual fund investors, it may mean nothing, because if you are investing for next 5 years, 10 years, 15 years, it doesn't matter. Investors should do a couple of things, and they're not very sophisticated, they're not very complicated, they're simple things. One is that in the course of our investment, we end up being a collector. So clean your portfolio, align your portfolio in line with your goals. So that is one. Here Value Research Online can actually help you do that. Upload your investment portfolio, the one which you get from the registrars, upload it, and it might give you, how to consolidate your portfolio. Consolidate in 4, 5, 6 funds. That is what most investors need, nothing beyond that. So clean up your portfolio. The other is that if the accumulation has become something meaningful, then decide on an asset allocation, because and we have talked about how to go about setting your asset allocation. Because early years, if you are very early in your investment phase, in your investment journey, you don't have enough accumulation, don't worry, carry on with your SIP. If it has become something meaningful, and I would like to define that, what is that meaningful thing? If it is 5 times of, if all your accumulation is adding up to 5 years of your earnings, then I would say that it is meaningful. Because the definition of meaningful is that if it slips substantially in a brief period of time. I would say set your asset allocation as well. We keep talking about it, but we don't do it. And we have talked about how to go about setting your asset allocation. Initial phases, you don't worry much, keep investing. Once you have meaningful accumulation, then worry about it, set your allocation, and depending on how distant, how far off you are from your retirement or needing that money, accordingly you decide how much should be in fixed income. If you're likely to need substantial part of the money in near future, then maybe 2/3 of your money should be in fixed income. If you are early phase of your investment journey and the amount has become meaningful, then maybe 1/3 of your money should be in fixed income, so that you get an opportunity to capitalize on any big decline that comes your way. If you follow these principles, then most of the things are sorted. After that, your only responsibility is choosing good investment and choosing suitable investment, which means that you should have appropriate investment. If you still are in, you have 5, 7 years, 10 years substantial part in equity, plan your investment, invest in short-term debt fund or liquid fund depending on your needs. Appropriate investment, you will not have anxiety. And of course, never forget the basic rule that you should be diversified. You should not try to benefit from some perfect timing of the market, and avoid anything exotic, a sectoral fund, a thematic fund, or something which looks too good to be true, but it is performing and that attracts you. Keep away from that. Things turn around when you least expect it. The first don't is that you invest or you accumulate for your retirement or a long-term goal, long-term financial goal, and you are getting closer to that, but the market is going up and you are not pulling your money out. The greed is overtaking you. Frame some discipline, rule for yourself, that what percentage of your money should be with you in fixed income or your bank account or a liquid fund. How long before you need that money? Because if you don't do that, you will be in for a not so pleasant surprise. So it's important that you stick to that rule of exiting your investment way before you need it, depending on the kind of goal. Then avoiding something, a bull run like this, you will find that there are kind of funds which are very narrow and they're doing exceptionally well. They will attract you. Look at the PSU banks or the PSU funds. They have given more, 3 times more return than the index in last 1 year, and that will tempt you, and that could be very disappointing. You can ride it for a while, but I don't know when it will turn around. And when it turns around, it could be sharp, just as sharp as its surge. So be very careful about that. Don't invest in stocks directly unless you are doing some groundwork. Because if you are not doing it for a reason, just because prices are going up is not a good enough reason. And if that is basically attracting you to the market to invest directly, you will be attracted to the nastiest component part of the market, because many a times in a phase like this, they are the performing ones and then they collapse and never to make a comeback. Two more things which one should be keeping away from, which is mid and small cap universe, it will be very tempting. Third is that too much of analysis. There's too much of noise, and people are trying to support the rise surge of the market with some kind of theory. Don't fall for it.
I hope you got your takeaways from today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.